Hello folks, this is John Riley from Cornerstone Investment Services with our March 2014 Economic Update. In this video, we'll be talking about some of the major events that moved the markets in the first quarter of this year. We'll also update you on our strategies and what might affect markets in the weeks and months ahead. Markets were volatile throughout the first 3 months of the year when a chilly winter and lackluster economic data caused stocks to lose some steam. The Dow gave outgoing Fed Chair Bernanke a worrisome send-off by dropping 7.5% in January. However, the Yellen rally started almost precisely when the new Fed Chair took office, sending the Dow up to new highs. This, we believe, was in part to her very dovish remarks that calmed the markets and reassured them that she was ready to keep the money pump flowing if the economy even hiccups. There may be a new bartender at the Fed, but she's serving the same old drinks. After growing 2.6% in the fourth quarter of 2013, the economy likely slowed in the first quarter of 2014. Though we don't have official numbers yet, predictions on GDP growth range from 1.2% to 1.5%. Unusually cold weather across much of the United States caused slowdowns in the labor market, manufacturing sector, housing, and other important segments of the economy. Now that spring is here, many economists are looking for signs that the economy is self-sustaining. It needs to rely on its own fundamentals and not the Fed's generosity. The February jobs report showed that job growth accelerated more than expected. However, according to the Center on Budget and Policy Priorities, there were 422,000 fewer non-farm payroll jobs in March of 2014 than when the recession began. To put this into perspective, the unemployment rate today is higher than in the start of 9 of the past 10 recessions since 1950. A recession starts on average every 6.4 years. So since the last one started in 2007, the next one could be expected to start at any time. We're not predicting one, but the high unemployment at the end of such a long, weak recovery shows how fragile and vulnerable the recovery might be. The Federal Reserve held an FOMC meeting and voted to continue dialing back its monthly bond purchases while keeping interest rates low. At this rate, the Federal Reserve's quantitative easing program will end in the fall of 2014, probably just in time to start a new program. Fed Chair Janet Yellen clarified the Fed's position by stating that though she believed the economy is strengthening, additional quantitative easing is still necessary to protect growth. In other words, Yellen is ready to turn on the spigots, and the market liked that. Global worries dominated headlines for much of February and March and caused some stock market jitters as investors processed how a new Ukrainian crisis might affect global trade. Emerging markets saw significant outflows as investors feared the Federal Reserve tapering might expose weaknesses in developing economies. They shifted assets to the developed world, where the weaknesses are on display for all to see and ignore. Our strategies have shifted a bit due to changes internally and externally. Internally, we're more tactical with all portfolios, willing to trade and exit positions sooner. Our reliance on fundamentals for our long-term strategies is not going away, but we recognize that the markets have become more technical and less fundamentally based. While we believe this is a short-term phenomenon, it's been going on for much longer than we would have expected. To that end, we've reduced exposure to emerging markets. Although our research shows that the long-term outlook is good, short-term, global investors can be myopic sometimes and focus only on today's events, not long-term fundamental trends. We've also reduced our asset allocation to hard assets. This includes gold, gold miners, and many commodities. We've increased our exposure to U.S. energy companies, though. We've also increased our exposure to U.S. equities. Our focus on positions we buy is mainly dividend yield and growth. But even these will be sold if the technicals turn against them. This is the application of a more tactical strategy. The tactical strategy portfolio itself has been doing its job, giving clients exposure to the U.S. equity market while maintaining an exit strategy. With the volatility this year, the tactical has dropped several sectors until it was down to only 4 sectors. One more, and it would have been raising cash to help protect investors. But once Janet Yellen started to give comfort to the markets, and the markets turned around, that tactical strategy added back some of the sectors it dropped. As always, we will be watching the portfolios and making adjustments accordingly. Once again, this is John Riley with Cornerstone, signing off for the month of March 2014. I hope you found this commentary interesting and informative, and if you have any questions or would like to talk to us about your personal financial situation, please give us a call at 401-453-5550. We'd be happy to speak with you. Thank you very much.